What is an immediate financing arrangement? Well, with the state of the world and the Canadian economy right now, you're probably going to hear more and more about this concept. I'm telling you right now as well that 3/4 of the people that are talking about this should never talk about this. The immediate financing arrangement is an advanced strategy that should only be done by professionals who know what they're doing and should only be done for the right type of clients who are financially sophisticated and have a stable, high cash flow and high net worth. There are a lot of yahoos out there trying to make a buck. Please stay away. So in this video, I'm going to keep it very simple and give a high-level overview of the who, what, when, how, and why. I'm not going to go too deep in the weeds because these things can go very deep and everybody's situation is different. So if this is something that you want to do, you're going to need more than a YouTube video of information, but this will get you started on the right path. So let's start with who is it for? This strategy is great for people who need a large amount of permanent insurance but don't want to tie up large amounts of capital in a life insurance policy. Generally, but not always, they are incorporated business owners with a holding company that is saving significant retained earnings into the holdco each year. There's another who question that needs to be answered as well. Who's involved? There are two main parties involved in this, and they work together, but they're completely separate entities. First, you work with an insurance company who offers a dividend-paying, participating whole life policy. This is the core element of the strategy that you need, and it's the main reason that you're doing this strategy. The second who is the bank. The bank actually is who invented the name immediate financing arrangement. It's their term for this type of lending that we're going to talk about. The bank is who we're going to bring the insurance policy to as collateral. And then if the bank underwriting accepts you, they set up a credit facility against the cash surrender value of this life insurance policy. We also need to work with the business owner's accountant and the lawyer in order to get this thing set up properly and to get all the paperwork done correctly. As part of our service, we coordinate all the information between the various parties and we make sure that everyone has what they need to move forward. So that's you, insurance company, bank, your accountant, your lawyer. And then if you need an introduction to a good accountant or lawyer that understands insurance and how these strategies work, we have a network across Canada that we can introduce you to. This is very specialized information and not all lawyers and not all accountants specialize in life insurance or corporate structure or tax. So it's best to work with somebody who knows what they're doing. And if your accountant or lawyer needs support, we can introduce them to the right subject matter expert for a consultation. So now we want to talk about how does it work? Well, how it works is that the business owner has retained earnings inside the holdco. And this can be also inside the operating company, but generally it's better to have the separation and have the funds inside your holding company. And you can see our other two videos on YouTube about why you need a holding company. You just search them. So we're going to take the funds that are held in your holdco and use them to purchase a participating whole life insurance policy. And we're going to wrap up all the money inside this insurance contract. And why insurance? Well, the business owner needs the life insurance, of course. And suitable clients for this will have their own house, they'll have a family, they'll have a business. So there's generally a large insurance need now and an even bigger insurance need when they pass. And then the bonus is that by using this strategy, you get all of the permanent life insurance that you need and you don't tie up your cash. So you keep liquidity by leveraging the insurance policy. The reason you can leverage so easily is because it's such a safe and secure asset to own. And even more value is the special legal and tax attributes given to life insurance in Canada. Life insurance in Canada is considered tax exempt, and the growth inside these policies is tax deferred. So the rules around insurance in Canada have their own legislation. It's called the Insurance Act, and it's older than the Bank Act and it's older than the Income Tax Act, and it's got many advantages. And Canada is one of the last countries where you can actually set up these types of permanent insurance policies. And I personally feel that it's something that we should defend as much as possible and not let politicians or the tax man mess with it, and they really want to, but that's a different topic. Now, what we're going to do is we're going to overfund the life insurance policy to the maximum allowed by the CRA. And we do this so we can get as much cash surrender value as possible, because the cash surrender value is what the bank looks at to secure the loan. Once we have the insurance policy in place, we take that policy across the street to the bank and we assign it as collateral security. And then in return, the bank gives the business owner a loan or a line of credit, a credit facility against the life insurance policy. So some banks will set up a demand loan and some will set up a revolving line of credit, and we work with you to figure out what's the best for your specific situation. Now, each year, your holdco is going to make a large premium deposit into the life insurance policy. And when we get a confirmation of the premium deposit from the insurance company, we give that to the bank and they extend your facility. So your loan or your line of credit available grows every year. And you can make these really big, which is what we're going to talk about right now. And this sounds great, right? So why doesn't everybody do this and what does it take? Well, on the life insurance side, you can set up whatever premium amount you want as long as we can make a case for it. But on the bank side, they don't set up these immediate financing arrangements or the IFA lending unless you deposit a minimum amount into the policy every year. And the minimum depends on the bank, but the lowest minimum from one bank is an annual premium deposit of $50,000 or $100,000, but most banks want to see a minimum $300,000 annual deposit into the policy, and really that's a minimum. They want much more than that. So now you have this insurance policy set up and you're making your annual premium deposits, and you have the line of credit or the loan facility set up at the bank. What do you do with it? Well, you can do whatever you want with the money, but you have to be careful because you are using borrowed funds. So obviously we don't suggest that you go out and buy Lamborghinis for all your friends, but technically you could do that if you want. We highly recommend that clients use these funds to invest. You invest back in your business, you invest in another business, you invest in the market or real estate. Some of our clients use this to grow their business or to buy inventory or to float receivables in the operating company. And one franchisee client uses this strategy to buy more franchise locations, basically using profits from one store to fund the policy and then leveraging the policy to buy more locations. Great idea. We also recommend you don't invest this money in anything too crazy risky where you could lose it, because we are dealing with leverage here and you do owe the money and you do have to make annual premium deposits to the policy and you do need to service the debt with the bank with monthly interest payments that do get bigger every year. So this is how we strongly suggest that you use your immediate financing arrangement or your IFA during your working years. Things can change when you start to hit retirement, say 50 or 55 years and over. And then after this age, we set up a different financing arrangement with the bank, and we use the same policy that you've already funded for all these years. And we can switch the loan type to what's called an insured retirement plan or an IRP, which is a great way to supplement retirement income with tax advantages and guarantees. But that's another video, and our video for insured retirement plan or IRP should come up in the suggested videos and you can just search it. All of our videos are on youtube.com/safepacific and they're all free. None of them are restricted. You don't have to give us your email or anything like that. So that's it. That's our quick rundown of the immediate financing arrangement, IFA, and how it does it work. And if you got value from today's video, can I ask a favor? Please do one of those things that the algorithm likes. Click share, click like, comment, subscribe. Any of those things, it helps these videos go further and it helps to reach more people. That's it for today, and I will see you next time.